Hello everyone, it's Friday, August 1. Today we're taking a closer look at the euro and British pound charts to assess potential market moves. The euro posted a modest rebound in early trading yesterday, buoyed by stronger than expected labor market data out of Germany and the euro area. The Eurozone's unemployment rate held steady at 6.2% in June, outperforming the projected 6.3%. This helped the single currency recover slightly after a steep sell-off triggered by their recent Fed meeting. Germany's inflation data also supported sentiment. Consumer prices in Europe's largest economy rose by 0.3% in July, slightly above the forecast of 0.2%. The data suggests that Germany continues to demonstrate resilience in the face of Donald Trump's aggressive tariff measures announced in April. The 15% tariff rate agreed upon by the United States and the European Union will likely help keep inflation within the ECB's target range. This could allow for further rate cuts if economic stimulus is needed in the future. As for U.S. statistics, traders digested a fresh batch of macro data. Weekly jobless claims came in slightly below expectations, allowing the dollar to recoup early losses. Meanwhile, the core PCE price index, the Fed's preferred inflation gauge, aligned with estimates. The monthly reading showed a 0.3% increase in June, following a 0.2% uptick in May. Year-over-year, the figure remained unchanged at 2.8%, just above the 2.7% forecast. These inflation readings reinforce the Fed's cautious stance, with tariffs on key U.S. trade partners officially taking effect today, August 1. Policymakers are likely to maintain a wait-and-see approach rather than move prematurely on interest rate cuts. Turning to today's macroeconomic calendar, a series of key data releases is in focus. The day starts with manufacturing PMI readings from France, Italy, Germany, and the broader euro area. All indices are expected to remain below the critical 50-point threshold, signaling continued contraction in the sector. However, any upside surprise could give the euro a boost at the start of the month. The UK will also publish its manufacturing PMI, with a July figure projected at 48.2, likewise below 50, indicating a further decrease in industrial activity. Attention will then shift to Eurozone inflation data. Both the headline CPI and core CPI are expected to ease in July to 1.9% and 2.3% respectively. These readings are broadly aligned with the European Central Bank's 2% target, providing room to maintain an accommodative stance, even if rate cuts are likely in the immediate future. Across the Atlantic, the spotlight will be on the U.S. non-farm payrolls report. After 3 consecutive monthly increases of 147,000, July payrolls are expected to rise by just 106,000. A disappointing result could wane on the dollar and support risky assets, allowing the euro and the British pound to recover. Such an outcome would also intensify pressure on the Federal Reserve, raising the probability of a rate cut in September. Futures markets currently see a 40% chance of a rate reduction, down from 60% before the Fed's latest meeting. What is more, the U.S. unemployment rate is forecast to tick up from 4.1% to 4.2%. If the actual figure exceeds expectations, it would add to the bearish case for the dollar and potentially lift the oversold euro and sterling. Now let's turn to the technical picture. The EUR-USD pair continues to trade within yesterday's sideways range. A decline followed by a false breakout at 1.1408 would generate a buy signal, with the euro likely to rebound toward 14.56. A breakout and consolidation above these levels would open the way for a move to 1.1501 and potentially further to 1533. At this level, I would recommend going short on a rebound, targeting a 25-30 pip correction. Short entries at 1.1501 and 1456 could be considered in case of a false breakout, especially if Eurozone manufacturing data disappoints. However, if the price breaks through 1408 and holds below it, selling pressure on the euro would increase. In the event of strong US jobs data, the euro could extend weakness to 1377 and possibly down to 1347. At this mark, a long positions on a rebound would be justified, aiming for an intraday recovery of 30-35 pips. Long entries at 1377 and 1408 should only be considered after confirmed false breakout. Speaking of the British pound, the setup is quite similar. A false breakout at 3180 would offer buying opportunity, with sterling likely to recover toward 3230. If bulls manage to gain control and break above these levels, especially on the back of strong manufacturing PMI data, we could see a continued rally to 3273 with an extended target at 3311. At this level, it would make sense to consider short positions on rebound, aiming for 30-35 pip pullback. Short entries around 3273 and 3230 should only be considered after a false breakout, assuming that the broader downtrend remains in play. If bullish momentum fades and the price breaks below 3180, pressure on sterling could intensify, dragging the pair down to 1.3126 and possibly as low as 3080. At this mark, I would recommend going long on a rebound, targeting an intraday correction of 35-40 pips. Long positions from 3126 and 3180 would only be valid if confirmed by a false breakout. Good luck to everyone.